Hello, everyone. Welcome to our first quarter webinar here at Black Diamond. My name is Auth. I'm one of the mergers and acquisitions leaders here. Our goal is to help people buy and sell businesses and create the most value where we can. Join alongside Andy and Christian.
Thank you. Thank you. Well, first up, we're going to talk about structure. And Lane is going to discuss structure with us.
Before we jump in there, want to give a quick intro about yourself?
Yes, I'm Andy Riethmaier. I'm one of the M&A leaders here at Black Diamond. Happy to be here and hope you guys have a good morning.
Thanks for facilitating this for us, Andy.
Right.
I'm Christian Baldwin, Managing Director at Black Diamond. Happy to be with you guys today. So our normal process is we do a 30-minute webinar of content that will offer 15 minutes of Q&A at the end. We do one of these 4 times a year, that we usually do, and we're going to record it so that if you miss it or if you want to share it, then you're welcome to do that after the session today. So thank you for your time. Lane, you want to walk us through the structure? So the general concept of the webinar today is 5 things every business owner should know before they go to sell their business. So
Yeah, for sure. There's a lot of things to consider when selling a business, and the first thing we like to highlight is structure. In structure, always recommend talk with your attorney, talk with your accountant when you go through this process. But there's 2 ways to go about structuring a deal, and that's an asset sale and a stock sale. In an asset sale, and simple, you're selling your assets, goodwill of your business over to a new buyer and their new entity. So you'll keep your current entity itself, and then on a stock sale side, the buyer is buying the shares or the membership interest in your corporation or your LLC. Both have their advantages and disadvantages depending on the buyer and the seller. And there's always up to discussion on what's the best strategy for both parties. In an asset sale, you're more transitioning all the items over in your business from utilities to employees to contracts, and there's a lot of different little things. But for a buyer, there's a little bit more of a legal protection for themselves, any more lawsuits or whatever it may be in the past. And on a stock sale side, it's a little more of a quicker, more fluid transition in terms of getting the different accounts and different things of the business over to a seller or to a buyer, since they're just buying the entity as is. And like I mentioned, it's more of a what's best for both parties, and of course, talk to your advisors. That would help lead you to the right decision when going through the process. One example we have was a transaction we did last year. It was a pharmacy down in Texas, and we were going through the process. We were day before closing, and we were transferring the different accounts through an asset sale, just going through our laundry list. And one thing that wasn't supposed to transfer as of yet was the insurance. It was supposed to stay with the company for a few days after closing, just to protect the business going forward for both parties. And without our knowledge, the seller went home one night, night before closing, and called his insurance agent and shut off all his insurance, even though it was a requirement to close. So calling the next morning, going back and forth, calling the insurance agent, trying to figure it all out. Luckily, we were able to do so, but little things like that are fun stories to know, and always be mindful of what you're looking to do in terms of transition structure.
another example that we come across frequently is when you're transitioning the business, the employees sometimes you'll read that they have to be terminated in an asset deal and then rehired, which scares a lot of the sellers. And they always ask us, well, what does that really mean? I don't want to have to fire everybody. That doesn't make sense. And the reason that it's worded like that is when you have an asset deal, you've got a new legal entity that becomes the buying entity. And so the employer identification number from the employer's perspective is changing. And so usually it's a simultaneous type thing. There's really no big deal. It's more of a paper thing than anything else, where 1 minute the employees are employed by the previous selling entity, and then the next minute they're employed by the new buying entity. So since the EIN changes, then you've got to essentially terminate and rehire. And so just some education there that most business owners, we have to kind of talk them through that. which is different than a stock deal or a membership unit transaction because the employer ID doesn't change. And so if you have that scenario, then you don't need to do that exercise because it's still the same employer that it was prior to closing. So there's a couple of examples that we run into quite frequently when it comes to just how to handle that transition.
Thank you, guys. Next up, we're going to talk about consideration, and Christian's going to take the lead on.
Sure. So our second point that any business owner needs to think about before they sell their business is consideration. And there's three main forms of consideration. The first is the most common, obviously cash, right? So how much am I going to get at closing for my business when I sell it? The second is seller financing. We see more and more of that nowadays, and we actually like seller financing when it's done correctly because there's so many different variables that we can use to negotiate between the parties. You can, of course, negotiate interest rates and when payments are due and the AM schedules and things like that. And then once we get all that figured out, we hand it to the legal team and they make sure that it's correctly documented and securitized and all that good stuff. So, our role in that scenario is kind of the quarterback to make sure that the accountants and the lawyers are getting the information that they need for the team to make the best decision possible. The third form of consideration that's maybe not as common is what's called an earnout. And earnouts are a promise for future payment based on the performance of the company in the future. And that can be defined really however the parties want to define it. It could be gross revenue, for example, or it could be net operating income or EBITDA or whatever the case may be. The further you get from the top line, the harder it is to measure and monitor and audit in the future. And so we tend to shy away from things that are way down on the expense line item or things that would allow for the buyer to, create expenses that could influence that number in the future. Revenue is usually pretty easy to track and target because it's also represented on the tax return. A couple things to note, though, if an earnout is in the equation, you really have to get the advice of the accountant or really both accountants for the future reporting on it, because sometimes the purchase price at closing, if there's an earnout component in it, would be used to calculate the tax due in the calendar year for which the business actually sold, so on the closing date. And that's an anticipated number in the future. So it could be more or less than the anticipation that they think they're going to receive, depending on the performance metric. If that happens in a future calendar year or tax year, then there might have to be an amendment that's filed on the return. So you just want to think through all that, see if there's other ways from the accountant's perspective that may be more efficient for the selling entity. One example that we have recently or last couple of years, I mentioned that an earnout could be based on a timing metric. Okay, revenue, for example, for the next 2 or 3 years doesn't have to be based on time. It can be based on just hitting a certain target. And so our example there would be a fairly large telecom company that we sold, and the metric that was negotiated was number of subscribers, subscriber growth, a number of subscribers for 3 consecutive months. So it didn't have to be a certain calendar year or anything like that. They just wanted the subscriber base to increase enough and hold steady for basically 90 days. And so in theory, that could have happened the first 3 months after closing, or it could have taken some time to do it. Once that triggering point is met, then the funds are released and then off you go. So definitely some, the devil's in the details when it comes to earnouts. And, there's a lot of experience that you want to make sure you tap into if you're going to talk about those.
Yeah, and another thing to consider on the initial side of things when you're going through the negotiations for consideration here, going to an example we did for a transaction before was an e-commerce deal where they held large amounts of inventory with COVID and different things, holding up shipments out of China, Thailand, other countries. They were holding higher inventory levels, and one thing to consider is, are you operating with deposits, higher inventory levels, and those can maybe be used in negotiations for the cash consideration if you're operating outside of a normal operating level of your business, just to make sure that you're capturing everything that's going on with your business between you and the seller.
Thank you, guys. Next up, we're going to talk about due diligence. Lane is going to take the lead on this.
Yeah, after you've gotten through the structure and the consideration negotiations, the next phase for buyer when they're looking at business is to dive into due diligence. And it's important to make sure that your business is ready to go for the due diligence. We see many companies are, sometimes companies aren't. One thing we provide is a self-guided business preparation program that will be launching here soon that can kind of help you walk through the due diligence process. Typically, it's a long list of not only financial information but maybe asset information, employees. It's really the buyer wanting to get into the details of the business so they can truly understand what they're buying, and that's where sometimes you kind of come into a lot of things that you're learning about the business. One example we had as of late was on the e-commerce one I mentioned. Actually, they had a previous loan with Amazon many years ago that had a lien outstanding on it. They had paid it off, and it had been a zero balance for many years. But Amazon has this program where they just auto renew the lien and keep it going. So it just never comes off your business. And when you're coming down to the details to try and close a deal, it needs to be free and clear of all liens. And all of a sudden, you have an outstanding lien you're trying to find if you can talk to Jeff Bezos to get that off. But no, it's important to know that there's many different aspects, and having your business ready to go, prior to a sale, talking with your accountant, talking with any advisors, talking with your lawyer, getting your business ready to go so that hey, here's this document, hey, here's this asset list, hey, here's this operating agreement here, I got it all ready to go. It makes a transaction and a sale much easier, more fluid process for everyone involved.
Yeah, that Amazon story was pretty crazy, but we got it done in the end. Another recent example, as a part of due diligence, if we're quarterbacking this whole thing, you have to do a lien search, right? To your point, and sometimes we've seen so many instances where incorrect liens are filed on wrong entities or things like that, because it's easy to put a lien on a company's assets, and half the time business owners have no idea what liens are even out there on their businesses. And we saw one where there was it was the complete wrong entity because there was a similarly named entity in a different state, and they just filed it on the wrong one accidentally, right? And so taking the time to really clean up all that stuff is very important. And I mean, we could sit here all day and probably give examples of things that are uncovered. And most of the time, probably 99 times out of 100, there are not big issues. It's just things that have to be done so that the buyer's counsel can feel comfortable about the transaction. But what I like to tell business owners in this transaction is there's a second reason why this is important, and it's because you want a great jump off point for the transition and the new team taking over. Because sure enough, in the rush to get something closed, when that next calendar year rolls around or the next fiscal year, somebody in that new, finance office is going to say, hey, where's our tax ID for this, this certain account? Or what about these supplier agreements or vendor agreements? So where are they, and what do we have to assign, and all that kind of stuff? And so having it all organized is a huge help for sure.
Thanks, guys. Next up, we're going to talk about timing. Christian's going to lead us through that process.
Our fourth thing we're going to cover this morning is about timing, and why is timing important when you sell? Well, the thing that we tell business owners is, look, you tell us what you want. You don't have to sell 100% of your business all on day one, and you can work pretty much as long as you want to within reason after you sell. And so there's a lot of different flexibility here when it comes to how much you want to sell today and in the future, and how much do you want to work. And of course, you can sell it all on day one and walk away if that's agreeable, or you might sell part of it on day one and work for a little while. It just depends on what the goals of the current ownership are. And we see a lot of examples, right, guys, where you might have more than one owner and the objectives are different. We had one where we had one business owner had 50%, and the other two guys had the 24 each or something like that, and they all had different objectives. One wanted to just stop working immediately or as quickly as possible, and the other one wanted to work for another year, and then the third owner wanted to work for somewhere in the middle. And so just really clearly defining what those roles look like. Most of the time, buyers on the front end, they get a little nervous and they'll say, okay, we want somebody to work with us in this transition period for a certain amount of time. But most of the time, it ends up being less than that because they do develop a little bit of a comfort level with the business, especially if they're already in the industry. And so, we sometimes see transition agreements or employment contracts that say, we'll start with 90 days or even 6 months, but they can be renewed for another 6 months and things like that. There's all different sorts of parameters that can go in there for something like that. But timing is critical in the sense that you come back to the whole deal team, how you want to structure, and there can be timing implications for tax things and that sort of stuff too. But just in general, the current ownership, what they want to do is really the most important thing, and then we can kind of work around that.
Yeah, it's important for that transition of yourself on a personal side, but for your team as well. Many times you're in the business, you work there, this is your company for 30 plus years, you've grown it, and a lot of you have a lot of long-standing employees. You want to not just walk away the first day, you want to transition that relationship right with you and the new ownership. And then any outside relationships too, not only employees but customers as well. So you want to make sure you're right. It's not only good for you, but it's good for the buyer as well.
Okay, thank you. Now, next we're going to talk about legacy. So Lane's going to lead us in a discussion on legacy.
Yeah, if you kind of got into the final point, kind of worked all the details out. Legacy is the most important part of my aspect because many of the owners we come in working with, they found their business, they've worked it, they've grown it for 30 plus years, or maybe it's a multi-generational family that has just really grown out this company into a great business, and now they're letting it go. For many, it's part of the family, this business, and finding a buyer, whether it's an individual or strategic or investor group, whatever it may be, finding a buyer that not only do right for the business, help it grow, but will be the right, do right by your name and your family's name and the business's name, long-standing, not only for your customers, but the community. So it's very important for that. One example we have is a business owner had bought it and he had grown it out into this great big complex, and we found a family and an investor group, and it was, who do we go with? And we ended up going with the family that wanted to really see this out as a long-term hold for the family to grow and see the business on and on. And we felt it'd be a right fit for the what the current owner and seller had built over the years.
Yeah, I mean, legacy is something that is sometimes overlooked in initial discussion, but like you said, Lane, it is very important. And the business itself will usually, successful business will outlive the original founders by a long shot, right? And so that can be a great responsibility to think through those things. And we've actually had a lot of conversations with not just business attorneys, but estate attorneys and trust attorneys and things like that are involved with these families that have these private companies, because their legacy and how they leave part of that legacy behind is important. One of the best examples I can think of here is we sold a business that was a fairly large assisted living business, and the family that bought it, the first time a resident died really hit them very hard in a good way. It was like, he said to me, I guess I should have realized it, but this is the last stop that these residents and these patients have before they leave Earth. And that's a huge honor, right? It's a huge responsibility to be there for the family with that. So now when they transition that business, they're looking for some management team that's going to have that same heart, right? It's because there's a lot more to it than just the dollars that are involved. And it's how do they really want to be known, way after their time is up, and so that's important. So, and we've also had examples where we've had parents that own businesses, and they flat out told us, look, we don't want our kids owning the business. We actually hear that more now than we used to. And, if you ask why, the answer you get usually is, well, we don't want the business to become a family problem after we're gone, which is a different way to think about your legacy. So what they would rather do is convert the equity now to real dollars and distribute that through their trust and estate planning in the future, instead of trying to transition to, sons and nephews and nieces and daughters and whatever while they're still here, because they know that if in the future it does become a problem, even when they're long gone, they don't want that perceived burden, which is the first time I heard that, I was like, well, that's a different way to look at it, but it makes sense, I guess. And so they figure, well, I can go ahead and convert this now to cash and then distribute it out that way, and then let these children and grandchildren and stuff make their own decisions. And some of them still work in those businesses, and they do they do very well. So you never know, those situations, but those are soul searching kind of conversations, that have to be had.
Legacy is very important. I know that going forward, when you purchase a business, sometimes you're purchasing more than just assets or tangible. You're purchasing intangible assets such as trademarks or goodwill or personal goodwill. And sometimes that legacy is so important to the business because they have built their name, their business over multi generations. It's important to them that it be carried in a high degree going forward. So for the seller, sometimes legacy is very important, and that's very good consideration for them. Thank you, guys.
Amen. I guess the last thing I'll say is that depending on where the seller is or sellers are in their thought process of when they might want to consider this, there are some other steps that they need to go through. Like if you have enough time, one of the things we really encourage is just getting the business organized from a file standpoint. And that can be, really worthwhile no matter if they want to sell or not, because like getting a bank loan and things like that, those are all important things that would help with. And then, succession planning. That's another one where if you have the time to do it, then you should do it right, and there's different steps there that are involved too. And then trying to figure out what's the company worth and the valuation exercise. That's obviously a main component of it. And then the sell process, which we talked about a lot, this morning. So there's some other things that you can do ahead of the game to increase value. Now, all those steps are designed to increase the value when you want to engage an advisor to help sell. All right, well, we will let you all go and hope you have a great rest of your day. Thank you so much for your time, and we'll see you next time.